Good morning, everyone. Thanks for joining us. We are going to wait a couple more minutes for clients to join, and we'll probably kick off in the next minute or so. Right. Good morning, everyone. Thanks for joining us this morning. My name is Chris Eddy, and I am head of multi-asset funds at 10x Investments. Today, we're going to be conducting a performance review, as well as looking forward with some considerations around how to build portfolios for better outcomes looking into 2025. This webinar is for our current clients invested in our pre- and post-retirement products. So that's our RA, our preservation funds, as well as our living annuities. We're going to go through this session today. I've prepared a slide deck to really take you through some of the key themes and performance. What you will find is a question and answer button. Please feel free throughout the session to leave any questions that you do have. I'm going to go through the presentation, and then at the end of the session, leave about 10 to 15 minutes to answer questions. Hopefully, we can get to answering all questions that you do have. But if you don't, someone in the team or myself will definitely respond because we'll save those questions down. So let's kick off. I'm going to share my screen. So my screen should be up, and let's kick off. I mean, I think thinking back about 2024, it was certainly the year of elections around the world, and with that came a lot of uncertainty. Obviously, we had the Government of National Unity form in South Africa. We've had some very interesting election outcomes all around the world, and obviously most recently in the US. But despite a lot of uncertainty and a lot of volatility in markets and some slightly negative headlines, really it was a strong year for most equities around the world. So what you can see here, we've just pulled up equity market performance. All these returns are in rands, and what you can see, we've highlighted the two main global indices in pink, so that's MSCI World and MSCI Emerging Markets. So MSCI World really delivered strong returns in rands, about 23% for the year. But that was really driven by the US, which again was a standout equity market in 2024. It's good to see South African equities in rand terms delivered about 13% total return, outstripping many other emerging market peers. We can see down towards the bottom of the table, countries like Brazil, Mexico, some of our peers really struggled. So after a couple of years of quite soft and benign performance, it's good to see South African equities delivering strong returns. And you can think about these returns with where inflation came in 2024. So inflation was just under 3% for 2024. So really strong real returns, which is a great outcome for all of us as investors, because it means that we've been able to grow our wealth significantly above inflation, which is really the key for us. So that's on the equity market side. Something that was quite different about 2024 was that actually South African bonds, which are typically a defensive asset class, outperformed South African equities in a year that South African equities delivered strong returns. Part of that was the high yield on South African bonds that we had coming into the year. So you can see at Jan 24, South African bonds were yielding about 11.5%. So that means if you bought those bonds at the beginning of the year and there was no change in the yield, you would have earned 11.5%, which in and of itself is a fantastic outcome. But actually, what we had, if you look through that path, you saw yields back up from 11.5% to 12.5% in the run-up to the election. And then with the positive election outcome, a lot of that pre-election risk was priced out of the South African bond market, and yields fell about 200 basis points from the high, ending around about 10.5%. So if we take that over the full year, you earned 11.5% from income, and then you got about another 6% in terms of capital gains from bonds as those yields fell from 11.5 to 10.5, which meant in 2024, you had strong returns from growth assets, as well as strong returns from defensive assets. So across the board, assets underlying the portfolios delivered pleasing returns. And really going into the fourth quarter, it really all was about the US election. So we know that Trump was last week recently inaugurated as president in the US. I think everyone has read lots about some of the proposed and some of the different policy proposals coming into play. The reality is no one knows exactly which policies will be implemented, nor do they know the extent to which those policies will be implemented. Think about things like tariff. I think running up to the election, people were talking about 50%, even 100% tariffs on China. More recently, that seems to be watered down to about potentially 10%, and that's only maybe to kind of taking a wait and see approach. Interestingly, over the weekend, we saw Trump coming out to say that he's going to implement 25% tariffs on Colombia this week and potentially moving that to 50% next week because they weren't prepared to accept 2 planefuls of Colombians that were being deported out of the US. So the reality is there's a lot of uncertainty. What that means is that the range of outcomes in markets are much greater than usual. So you can think both to the upside and to the downside. The reality is no one knows exactly what's going to happen, and no one knows what the market impact and result to many of those policies are. So one taking that needs to say, well, potentially you need to brace for a little bit more volatility in markets. So following the US election, we saw really strong dollar performance. What we have on the chart here, and it's quite neat if you look at how the dollar's performance in following the 2024 election really followed the path of Trump's first victory in 2016. So the 0 on the bottom axis is effectively election day. And what you can see from that election day for the next kind of month and a half, this was really to the end of December, the dollar strengthened materially. And that really created a headwind for many assets outside of the US. You saw much higher yields driving some of that dollar strength. But interestingly, in 2016, after an initial period of dollar strength, the dollar started to weaken. And actually over this period in November and December last year, the rand really depreciated kind of 8 to 9% after being as low as about 17.30, sold off to the high 18s, even touching around 19 for a short while. So following that election, we had really a strong dollar, which hurt many, took the shine off what was really a strong year in 2024 in the last quarter. And US equities, again, as mentioned, were the standout equity market performer. Here we're looking at the returns in dollars. So if you overlay the currency depreciation, the 125 goes to about 129 for the S&P 500. But the reality is it wasn't necessarily a broad-based equity market rally. Those outsized returns were really heavily concentrated in a handful of shares, the Magnificent Seven, if you would, those mega cap tech shares really returned about 67% in 2024 in dollars. And that lifted the broad S&P 500 returns. If you look at a more well-diversified version of the S&P 500, the equal weight index, where every share has the same weighting rather than the market cap weighting, their US equities only returned about 13%, which was roughly in line with where SA equities were. So very concentrated, fantastic returns over the last couple of years, really over the last decade or so from US equities, but it does call into question whether that trend can continue indefinitely. So when we just kind of summarize and look at what the different asset classes did, here we pulled up returns all in rands to the end of December 2024. You can see the darker blue bar are the returns to each asset class over the full year of 2024. And the lighter blue bar just looks at the last quarter, so the last 3 months. So first, if we look at the 1-year returns, like I kind of alluded to, really strong returns across most asset classes. SA equities at 13, SA property just under 30%, S&P 500, so US equities also around 30%. Emerging markets slightly softer, but there you can see South African bonds also delivering 17%, even cash and linkers around 8 and 9. we're really pleasing returns when you think how low inflation was last year. So really strong real returns. But then when you zoom in on the 3-month window, you can see most asset classes really struggled. It was really only global cash, so given the rand depreciation, as well as the S&P 500 that had strong returns in the last quarter. So if we take those returns and we look at portfolio performance here, so just a note when we're looking at portfolio performance here, because each and every one of you pay a slightly different fee based on the size of your assets, kind of a sliding scale. What we've shown here are gross returns. They net of trading costs, but you would need to take your own individual fee off this to get a sense of what your performance was over the period. We're looking at kind of the shorter term as well as the longer term returns here. So 10x Your Future, that's our main high equity portfolio that most of our investors are invested in when they're saving for retirement. We've got kind of the risk profile, moderate and defensive as well. And then about 2 years ago, we launched the income fund as well, which is a more defensive offering without any growth asset exposure. I think there are two things that I want to call out on this chart. One is in a year of really strong returns, you saw pretty similar outcomes from the future fund, moderate fund, and defensive fund. And the main reason for that is the fact that SA bonds at 17% outperformed SA equities at 13%. So typically, in a year of strong returns, you would expect the future fund to deliver higher returns, which is what you see when you stretch out that time horizon over 5 years, 10 years, 15 years. So we've been running these strategies for more than 17 years now. Typically, over the longer term, you'd expect higher returns from the 10x Your Future portfolio, but that comes with a little bit more short-term volatility. Whereas funds like the defensive portfolio, there's less volatility. They have a higher allocation to growth assets, but that's with a lower allocation to growth assets, I should say, but that's with the trade-off of slightly lower longer-term returns. But this year was quite different because you had the same type of returns from all the portfolios, given what bonds did. So these are the funds available to our clients in a pre-retirement portfolios, so the RAs, preservation funds. They are also available to our clients in living annuities, but they are subject to Regulation 28. We do offer our living annuity clients who are not subject to Reg 28 portfolios with greater offshore exposure. And those are the portfolios that I'm bringing up on the screen here. So that's the 10x MSCI World Index Feeder Fund, which is 100% global equities. It's quite an aggressive portfolio. We then have the 10x International High Equity and 10x International Medium Equity. These portfolios typically have a much larger allocation to global developed market equities. And that's the one asset class that really has outperformed not only over the last year, but over the last 5, even 10 years. And we've seen these portfolios really benefiting from that higher exposure. So again, really strong returns in absolute sense, both in the pre-retirement portfolios as well as the post-retirement portfolios. Question now, looking forward, I think, which is really relevant, is what are the expectations for an asset class, one like developed market equities, which has a really high allocation to US equities, and how can we think about that when we build portfolios that really look to deliver improved retirement outcomes over long-term periods? So we know that really the last decade, actually the last 14 years, chart on the right-hand side shows you that the MSCI World, which is developed market equities, has absolutely trounced SA equities by more than 8% per year for 14 years. So 100 Rand invested in MSCI World would have grown to over 1,000 Rand over that 14-year period, so from 2010 to 2014, whereas 100 Rand invested in SA equities would have grown to just under 400 Rand. But what's quite interesting is when you look at the preceding decade, the picture was completely reversed. MSCI World in Rand, so developed market equities, really went almost nowhere for a full 12 years. They actually referred to the 2000s as the lost decade for the S&P 500. And there you can see in 1998, if you invested 100 Rand, 12 years later, that would have only grown to 154 Rand in offshore markets. Whereas in South Africa, off the back of really the commodity bull run and what was happening in China, SA equities would have, that 100 Rand would have grown to more than 900 Rand, which meant that SA outperformed developed markets by close to 17% per annum. So it's every year for 12 years. One decision based on how you allocated and how you kind of sized developed markets or South African markets in each decade would have made a meaningful impact on the type of retirement outcome and savings outcome that you would have had at the end of the decade. So it really was a tale of 2 decades. But the question now is, after this strong period of really fantastic returns, can one expect that continued really strong returns from what is ultimately US equities? And really, we think that from this point, there's been a fantastic return. But if you look purely at quantitative valuation metrics, so this is kind of no stories, just looking at the numbers, really it points to the fact that we are in a bubble-like valuation territory in US markets. So here we're looking at what's called the Cape earnings yield, and we compare that to the real yield on 10-year government bonds in the US. Really what it's supposed to say is how much additional reward is there from this point for investing in US equities relative to bonds. And what you can see is we've really, going back over the last 100 years to 1920, there have only been kind of 3 other times when you've had valuations for US equities at this point and this extreme. And what's quite interesting, they were all periods where there was a new technology that came into the market that was going to change life as we know it. In the 1920s, it was the automobile and electrification. In the late 1960s, early 1970s, it was the nifty 50s. These were the global conglomerates that were going to take over the world and provide really access to cheap manufacturing and production and really your one-stop shop for a consumer. In the 2000s or the late 90s, early 2000s, it was obviously the internet that was taking over the world. And more recently, it's obviously around AI and the role that AI is going to play in our lives. Now, I think the key important part here is that this chart doesn't look at any of the narratives or stories. It purely looks at numbers. And we're at the same level that previously created lost decades for US equities. Now, what is quite interesting to reflect back on those 3 other periods is that the technology and the innovation that came to the fore really did change life as we know it. The internet, I mean, it's so ingrained into everything that we do today. The reality is the market kind of ignored sort of the law of large numbers and just projected the dominance ultimately of those companies that were involved in bringing that technology to market. When, in fact, actually it was the consumer that benefited, and many of those companies weren't able to really deliver on the extremely bullish assumptions embedded in valuations at those turning points. So to give you kind of a sense, what we've just done is we've pulled out an example from one of those periods. So that was the dot-com bubble. And here we, on the left chart on the left-hand side, we picked out 4 shares that were in the 10 largest shares in 99, 2000. So not any of those unprofitable tech companies. Some of you can remember things like pet.com and many of these other businesses that weren't worth anything. These were large cash generative businesses at the time that were real serious businesses. Take Microsoft, for example. From 2000, Microsoft really went to go dominate both work and home computing. I mean, Windows became the preeminent and pretty much really the only operating system used for the next 2 decades. But the valuation and the extrapolation of euphoria around that kind of 99 peak, despite Microsoft going on to be a fantastic business, today it's actually still the 3rd largest business in the world. Very profitable, really went on to be successful. It took 14 years for investors to recover from that bubble high because it had this excessive valuation multiple applied to it. Ultimately, a way to think about 87 times PE ratio which is what was applied to Microsoft at the time, would be that that business would need to earn back its profits over the next 87 years. So the embedded assumption is that that business would continue to generate profits for the next 87 years, regardless of any threats to its competitive positioning or any peers. So it's really a lofty and a high headwind for that company to actually deliver returns and outcomes that are better than those expected. So the peak to trough drawdown was about 65% for Microsoft. It took 14 years to recover from that bubble high. And if we look at where we are now with many of these magnificent 7 businesses, you can see we had similar type lofty valuations, which really set the fact that expectations are really elevated. No one's saying these aren't going to be fantastic businesses that are dominating the world and will continue to go dominate. But the price that you pay today really does separate out what can be a great company from potentially a poor investment. Now, that's just to say, okay, these are these 7 shares. And we certainly aren't in the stock picking game. We invest in indices because we think that it's exceptionally hard for people to continue to deliver outperformance through stock picking. We generally think about indices as being a way to deliver fantastic diversification across a range of different shares to get exposure to global equity markets, local equity markets. The one thing we always are somewhat hesitant about is when there's significant concentration in the market. Historically, 10x's history, we've always applied capping, even before it was popular in the local equity market, to deal with concerns around any one single share or group of shares delivering and impacting your outcome as a retirement saver. So what we're seeing in US equity markets at the moment is that the market has become incredibly concentrated in the handful of shares. So if you look at the top 10, they make up just under 40%. I think the Mag 7 are at about 33% of these 500. You invested in 500 companies when you invest in the S&P 500, but just 10 of those make up nearly half, just over a third of that. So there's significant concentration in a handful of shares that are exhibiting bubble-like characteristics, which means that the broad US equity market is potentially kind of sitting in bubble territory as well. And that's what valuations certainly talk to. So when we think about mega cap tech shares, they are massively concentrated in US equities, and US equities are now significantly concentrated in broad MSCI World indices. So MSCI World Index, I think the US makes up more than 70% of that. So the look through into the concentration in these 7 shares is massive. And that's been a significant tailwind over the last 5 years in terms of delivering returns. But we are at a point now where those valuations become a significant headwind. So we don't know. We don't have a crystal ball. We don't know what's going to happen around AI, around whether these companies will continue to be successful. What we try and look at is put the narratives aside, put the stories aside, and let's look at pure numbers. In order to deliver returns, in equity markets, they come from 3 parts. They come from real earnings, they come from a dividend yield, and then a valuation re-rating. The chart on the left shows you that with a CAPE ratio, which is a cyclically adjusted PE ratio, it's our valuation metric of choice. It's at its 98th percentile in terms of how expensive the US market is. So at just under 38 times earnings. The average over the last 30 years has been about 28 times, and the average over the last 75 years has been about 20 times. If we continue to see strong earnings growth like we've seen over the last decade, and here we've used actually a whole range of different earnings growth assumptions. So these are real earnings growth above inflation, from 1% real all the way to 4% real. If you just had to revert back to the average over the last 30 years, not even the longer term average of about 28 times, here we've got 26 times on the table. You're setting up for a decade of 0 real returns from US equities, despite how successful these companies are, despite whether these companies deliver really strong earnings growth and compound that over the next decade, purely based on where valuations are. And actually, what we've tried to do here is we've tried to map a range of scenarios of different valuation points over the next 10 years and different earnings growth assumptions over the next 10 years. And you can see there's a large range of combinations that deliver returns below inflation +2 over the next decade. And this is really setting up a challenging environment for the last 10 years to be the same as the next 10 years. I mean, we did a little thought, just to run a bit of a thought experiment, to say if we get the same 10% per annum real returns from US equities, which is what we've got over the last decade, okay, and we assume the same earnings growth as the last decade, the valuation multiple here would need to go from 38 times to an unprecedented 58 times, purely just to deliver the same type of returns. And whilst there is an exceptionally small probability of that happening, we think from this point out, returns to this market is really challenged. But valuations are not a great timing tool. They tell you nothing about what's going to happen over the next 6 months. They tell you nothing about what's going to happen over the next 12 months. But they are incredibly powerful when you look out over the next 5 to 10 years. And if you think about what we're looking to do here is we're looking to build portfolios that deliver better retirement outcomes with an increased probability of generating real returns over a 5-year time horizon. We don't know what the next 6 months are going to hold. We don't know the next 12 months are going to hold. And to give you a sense of this, what we've done here is we've overlaid that same CAPE valuation multiple in light blue is the path that it took in 2024. So it started 2024 at an expensive level of about 32 times earnings, and it continued to get more expensive, going to 37 times earnings. And some of that valuation multiple expansion drove the strong returns we saw in US equities. If we use an analog here and we say what happened in that dot-com era, well, 2024 could have been 1998, and that means that 2025 might be 1999, and expensive can always get more expensive. And that 37 could grow to 44 times, which was the peak in December 1999. The market topped out in March 2000. And that was the start of the last decade for US equities. So the key point here is that even though valuations say US equities are really challenged when you stretch out that time horizon over the next 5 to 10 years, it doesn't tell you anything. What's expensive can get more expensive, and US equities can continue to run for the next 12 months. But we're not in the game of trying to do short-term market timing. It's incredibly difficult. Investors really struggle to consistently add value to that. So we think it's much better to stretch that longer-term time horizon out when you're looking to build portfolios to deliver better retirement outcomes on a long-term basis. This chart is just to show you, and it talks to the concentration in US equities. We've got sort of on the left-hand side 3 different indices, one being the S&P 500, one being the S&P 500 equal weight, which is a much more diversified exposure to US equities. It has a much lower weighting to those magnificent 7 shares. And what you can see is that actually not all equities are expensive in the US. If we just look at the darker blue line, so that S&P 500, and the S&P 500 equal weight, which is kind of the 10x blue or the royal blue line there, and you look at what happened to valuations over the last decade. The S&P 500 started at about 21 times and went all the way up to 35, or if you roll that forward a little bit more, 37 times. Whereas that S&P 500 equal weight was flat. It started at about 21 times and it ended at about 21 times. So there's been none of this excessive valuation built up in other parts of the US equity market. And I think the thing that really stood out for me and I found incredibly fascinating is that despite the narrative of tech growing earnings, that S&P 500 equal weight had stronger earnings growth over the last decade than the S&P 500 market cap with a heavy weighting in these tech shares. So what that is saying is that despite stronger earnings, the market is not rewarding the old style companies that aren't involved in this AI narrative and this AI theme, but they are extrapolating really significant growth over the next decade in AI and applying that to the earnings of these handful of businesses. So where we said US equities are setting up for a lost decade for S&P 500 market cap, pretty much like we had after the dot-com bubble, the same doesn't hold for other parts of the US equity market and other markets around the world. So again, not only from a valuation perspective, but from concerns around concentration risk, we are diversifying away some of that market cap exposure in our best house view portfolios, which are the 10x Your Future Fund, in order to deliver a better retirement outcome for our investors. And this provides a quick summary, ultimately, of the prospect of returns, not the retrospective, not what happened in the rearview mirror, but from today's current starting valuations, what returns can one expect across a range of asset classes on a forward-looking basis, and how do those expectations compare to what those asset classes have delivered over the long run? So the light blue bar is what each asset class has delivered through multiple different market cycles, so over the very long term. And the dark blue bar talks about, from today's starting valuation, what type of returns can we expect. And we've really highlighted the two asset classes that are showing the biggest disconnect from what we've experienced over the longer term. We spent a lot of time today talking about sort of the challenges to US equities, and we can see that while the rearview mirror, they've been the best asset class to invest in, from these really high valuations, it sets up a challenge for US equities going forward. And equally, given the size of US equities in developed market equities, there is a challenge on a forward-looking view for returns from developed market equities. So one can think about MSCI World Index as one of those portfolios. If we look at other growth assets, emerging market equities, developed market equities outside of the US, set to deliver better real returns, still slightly expensive, potentially somewhat lower than what we've seen through the cycle. And from an SA equity perspective, expectations roughly in line with what we've seen over the longer term, which is higher than what we've experienced over the last decade. But on the positive side, there's a fantastic opportunity sitting in South African bonds for South African investors. You can actually earn equity-like returns from investing in South African bonds, kind of roughly around inflation plus 5. Our favorite, and you might have heard us talk about them before, is obviously inflation-linked bonds, because the big risk from a South African perspective is that our fiscal trajectory changes, the rand depreciates significantly because of, some political concerns or risks. In that environment where the rand depreciates materially, the big risk to South Africa is inflation. So inflation-linked bonds protect you from that inflation, and they are currently giving you inflation plus 5, which is really a fantastic way to deliver retirement outcomes in a very low-risk way possible. So we've got a much higher allocation to South African bonds, and specifically inflation-linked bonds, because they're delivering equity-like returns. When we think about the outcome we're looking to deliver for the future fund, that's inflation plus 5.5, we can do that through inflation-linked bonds with very little risk. And when we look across the range of asset classes, the key takeaway is that defensive asset classes at this point are either fair or attractive. You can see the prospective returns are much higher than what they've delivered over the longer term. And that makes sense in an environment where we've had a structural reset higher in interest rates, not only in South Africa, but around the world. When interest rates move up, bonds typically suffer in value. But from that much higher starting point, from those much higher yields, you can really generate really attractive real returns with very little risk, compared to most growth assets, which are either fair or expensive. So when you put that together, that defensive assets are attractive to fair, and growth assets like equities are expensive to fair, what that means, and this is more specifically in the 10x Your Future Fund portfolio, but it talks to kind of more broader positioning across the future fund, the moderate fund, and the defensive fund. The international portfolios I'll touch on in a bit. But really, if you look at the bottom chart, you can see it summarizes it. growth assets versus defensive assets. We're underweight growth assets. We have a high allocation to defensive assets. And that's predominantly driven by underweight developed market equities, given the concerns around US equity valuations, and a much higher allocation to South African inflation-linked bonds, given the equity-like returns that this asset class is offering on a forward-looking basis. So that gives you kind of a summary in terms of how we are looking to improve the probability of delivering a better retirement outcome for our clients, whilst taking as little risk as possible. It's all about delivering the best risk-adjusted returns. When we look to build these portfolios, we do not know what the next 6 months hold. We do not know what the next 12 months hold, but we do so looking out over the next 5 years to ensure that we're trying to give you the best probability of meeting your retirement goals. When it comes to the international portfolios, those have been specifically built for clients who are looking for a much higher allocation to offshore markets and offshore exposure. As a result, they do have a much higher allocation to MSCI World assets, and that has been a fantastic allocation to clients, and it may continue to be a fantastic investment for clients going forward. We're just saying in terms of how we build portfolios to maximize the probability of delivering a better outcome, given how high valuations are in those markets, we're looking to ultimately downweight developed market equity exposure in our house view portfolios, which are. So I'm going to pause there. Hopefully, to understand how portfolios performed over the last year. So really pleasing absolute returns when we think about where inflation was. It didn't actually matter which portfolio you were in 2024. You grew your wealth significantly above inflation, which is the outcome that we're looking to deliver for our clients. Developed market equities delivered fantastic returns, not only over the last year, over the last 14 years, but we do seem to be at bubble-like equity valuations, specifically in US market cap exposure, and that creates headwinds and challenges for that asset class going forward. One also just needs to be cognizant about kind of the size of those mega cap and Magnificent Seven shares in your portfolio, because the US has grown in size. These shares are a large part of the US, and as a result in developed market equities as well. And it's not all negative news, though. I think that's the important thing. There are lots of opportunities to deliver significant real returns to portfolios. South African bonds are a great example of that. So when we think about building portfolios to maximize the probability of delivering better South African inflation-linked returns going forward over the next decade, we've got a higher allocation to those South African bonds and a lower allocation to developed market equities. Kind of summarizes, I think, the drivers of performance, the actual performance, and some thoughts looking forward over the next year. I'm going to turn my attention to some questions now and start going through them. So if you do have anything on your mind, please do send them through. I can see a question here from Andre in terms of what's your home view with respect to long-term value of global versus local equity funds over the next 5 to 10 years. I think I've answered that in terms of the summarizing slide that was posted at the beginning of the session. There's a question here asking, how does 10x MSCI World Feeder differ from Satrix MSCI? So it's how we look to how we ultimately implement that exposure. That the actual shares that you're investing in are exactly the same. The only things that will differ is how that exposure is delivered into the portfolio and what fee that exposure comes at. But for all intents and purposes, as an investor, you're investing in the same exposure. There's another question saying, for a tale of 2 decades, are the graphs showing nominal or real returns per annum? Those we were showing nominal returns per annum, but in rands. And to give you a high-level view, I mean, inflation over the last kind of 10, even 20 years has been roughly about 5%. So what we're showing here is where SA outperforms DM and then DM outperforms EM is the relative outperformance. So that relative outperformance, because we're looking at returns in rands, would be the same whether those returns were real or nominal, because you would subtract inflation from both sets of returns. So the differential would still hold. There's another question to say, you have a facility to invest in MSCI World Index. Why don't you have one to invest in NASDAQ 100? Look, we're not necessarily in the game of product proliferation. We're looking specifically when it comes to offering solutions for our clients to deliver retirement, pre and post returns. Significant choice often doesn't lead to the best outcomes. We're really looking at offering the portfolios that are, one, well diversified, and two, more suited to delivering on investment outcomes framed in CPI plus. That's why we typically offer multi-asset portfolios. The MSCI World offering in the living annuity was kind of brought to the fore for some specific clients who have a lot of a high concentration in South African assets and very low concentration in global growth assets. And it's the globally diversified equity exposure. So at this point, I don't think we would be looking to offer more niche equity-like exposures into the portfolios, because we're really trying to look out over the long term in terms of how we deliver outcomes. There's another question around Chinese stocks. So we kept today's feedback session on relatively try to kind of narrow down what we were talking about, and we really spoke to US equities, because we do think that out of all the allocation decisions, that's the one that probably has the biggest impact on client outcomes over the next 5 years. When we talk about Chinese stocks, it's quite an interesting parallel, because everyone has been very bullish in terms of expectations on the US. You can hear about US exceptionalism, think about all the potential deregulation, tax cuts that are coming out of sort of Trump, US being the center for innovation and AI. And this really bullish expectation about what the US is going to deliver over the next 10 years. And that's kind of driven that valuation expansion. In China, the story's really flipped on its head. China equities have been they had a good year in 2024, but before that, they had 3 years of really derating. China's growth has been flatlining. They really are going through a balance sheet recession where there's significant deflation coming out of China. But converse to the positive expectations in the US, China is really, all you read about headlines is that it's become uninvestable. You can't allocate to Chinese markets. You've seen before where most people allocated to emerging markets as an asset class. Emerging markets ex-China has been created as an asset class in China, stripped out separately. And actually, if you look at it, Chinese valuations are relatively attractive versus the long run. And expectations are very low as well, and those kind of perpetuate. So the bar for improvements from this starting point is pretty low for Chinese equities. And the bar for disappointment is also pretty low from a US equity perspective. So I'd almost say those two markets are they are mirror images of each other. So question around real return. Yes, so real return is very much after accounting for inflation. Because as you know, inflation makes the prices of everything that you buy every year more expensive. So you really need to think about the growth of your investments in real returns. How much more have I grown my wealth above inflation? Because that means in real terms, after adjusting for inflation, I've become more wealthy. If you're just keeping pace with inflation, you're not really growing what you can afford to purchase, or what you can, or the lifestyle you can afford to live, or how you can afford to provide for yourself in retirement. So one really needs to remove inflation to understand your true growth and wealth. And that's why when we think about building portfolios to deliver outcomes, we always think about it in the real return space. So that return above inflation. There's a question here around that was posted while we we're going through. What's your view on excellent US equity market performance will reverse in 2025? Again, I want to stress this point. We don't know what's going to happen over the next 6 months or over the next 12 months. What's expensive can always become more expensive. What's irrational can always become more irrational. Valuations do not help you over the next 6 months or the next 12 months. So if people are saying, I want to change my allocation because of valuations, and then they evaluate that over a 6 or 12-month window, it's pretty pointless, because it does not have, and if you model it statistically, there's no statistical relationship between valuations and kind of the next 12-month returns. But if you look out over the next 5 years, over the next 10 years, they are incredibly strong at setting expectations over the longer term. So again, I don't know, we don't know what 2025 may hold, but we're not managing money for 12 months. We're managing money to deliver retirement outcomes over the next 5 years. And on that view, US equity performance will certainly be challenged, and we're setting up for potentially what could be a lost decade from this point. What is the questions around what's the best suitable investment option after retirement? Temi, that is a very personal and client-specific question. I would encourage you to reach out to our investment consultants as they talk to many clients about that specific option. Every day they provide kind of a range of factual information and what the different options are and how those are suitable for certain situations and not for other situations. So I would encourage you to reach out and chat to our investment consultants, and they would certainly be able to help you with that. And there's a question here: what is the cost to switch funds? There's no cost to switch funds, in no direct cost to switch funds for 10x. What I would caution about, and this is very much more around managing expectations in retirement, is that research shows that switching your investment frequently destroys a lot of value. Because typically, when you're switching, if you haven't spent a lot of time to set your expectations, understand what the prospective view looks like, many clients ultimately will chase performance. What was the thing that did the best over the last 12 months? I want to be invested in that. I'm going to switch to that. But that performance chasing has been shown to really destroy clients' value over the longer term. So I wouldn't encourage frequent switching, but what I would encourage is understanding how you invested, as well as the expectations that you have for investing in that way. I'll use an example here. If you invest in the future fund versus the defensive fund, the future fund has a much higher allocation to growth assets. The defensive fund has a much lower allocation to growth assets. What does that mean? Over the shorter term, one will expect the future fund to be a lot more volatile, whereas over the longer term, you'd expect much higher returns. So as you sit today, if you invest in the future fund, and it is a lot, and we go into a period of significant volatility, and it underperforms the defensive fund, well, that's what it's built to do. But sticking the course and holding and staying invested for the longer term will see a longer term, a better return through multiple cycles. And conversely, if you're investing in the defensive portfolio, you know you're going to sleep a lot better tonight, but your long-term real returns may be slightly lower. As long as you're aware of that and you don't wake up in 15 or 20 years time and say, you know what, I don't have enough invested to sustain myself in retirement. Well, be aware that that's the choice that you made to invest more conservatively, which helped you sleep well on a night-to-night basis. And I'm not saying either of those options is the right way. It's going to be very specific based on what you want, but I will encourage you to know how you invested, to understand what that means for how that portfolio will perform in different market environments. And then if those different market environments occur, don't panic and switch at the wrong point. You want to if you are going to switch, you don't want it to be driven by market performance. You want it to be driven by what is the outcome you need and what kind of is the prospective outcome for these different portfolios on a forward-looking basis. Ronald was asking, I have a retirement annuity. How do I check which shares I'm invested in? Best place to look is the fact sheet. If it's the 10x portfolios, you can also kind of phone in and chat to our team. They'll also take you through that. But I would say look on your fact sheets, should show you that information. There's a question saying, will your fees ever change? Just like a competitor down the road, they've just shafted their customers. From where we're sitting, we have been very intentional in terms of offering our products at a sustainable and fair pricing point. So like some of our peers down the road, they might have been at the lowest price point. We were never at the lowest price point offering, because we said, what is the pricing that is fair but also sustainable for our business? And that's why we weren't in the game of racing to the bottom, but we're ensuring that we are offering our products at a competitive price point, which improves your probability of success because it's much lower than most of the industry, but it's also at a point that's sustainable for our business to continue offering our service levels at our current price points. There's a great question here. Our returns compared to our RSA peers. So, I mean, today was specifically looking at a range of our different portfolios, from the future fund to the moderate fund to the defensive fund, as well as our international options. A quick high-level summary, if you're comparing to kind of high equity balanced funds. In the future fund, we have been slowly decreasing our exposure to US equities as that market has been getting more and more expensive, because it's setting up for much poorer returns over the longer term. Whereas in the international portfolios, there's a much higher allocation to those global growth assets. So relative to our peers, our international portfolios have significantly outperformed because of that higher allocation to global growth assets. Our future fund has been slightly softer over the last 12 months because we've had a lower allocation to US equities. But over the longer term time horizons, 3, 5, 10, 15, we've continued to significantly outperform. But for us, it's not about, we obviously look at and we're worried about short-term performance. But for us, the focus is on delivering the outcome that's going to improve your retirement outcome and deliver the best risk-adjusted returns on a forward-looking basis. So I'll go back to this point. US equities continue to run over the next 6 months or the next 12 months. One may expect our performance to be slightly softer than our peers. But in that environment, the absolute returns that will be generated will still be significant and well above inflation. However, if there are significant headwinds that come through from the US and the elevated valuation multiples that we're currently sitting at, our clients won't be as overexposed to that part of the market and exposed to other asset classes which are set to deliver inflation-beating returns. So it's not to say the portfolio won't suffer if there's a market sell-off, but our clients will ultimately be slightly more protected because we're building a portfolio today that looks out over the next 5 years to generate the best risk-adjusted returns. If I'm looking at questions here, there's a question around what effect will recent issues on the GNU, especially with the expropriation of property bill, have on potential investment going forward? What do we do to safeguard against this type of thing as much as possible going forward? Well, Peter, the question is, no one knows exactly what's going to happen. No one knows the risks. There's upside risks, there's downside risks. I mean, there obviously is a lot of noise and concern around the stability of the GNU more frequently. Remember, we also have local government elections coming up. There's also a new ANC elective conference in a couple of years' time. All of these will create challenges for the current status quo. The key for us is to ensure that you are well diversified across many different sources of returns, and you're not betting the house on any one outcome. So we're not betting the house on a South African recovery. We're not betting the house not even being necessarily invested in the US. We still have some exposure to US equities. We just have downweighted that and bought in diversification, because it never really pays to bet on any one outcome, because you may get it right or you may get it wrong. For us, it's trying to set aside some of the narratives and understand where are we being compensated for taking risk. And we build a portfolio from that perspective. We then run it through multiple different scenarios to understand if there's a collapse in the GNU and the rand depreciates materially and there's a big uptick in inflation, how will the portfolio perform? If there's a dot-com burst, how will the portfolio perform? If there's a big run-up in US equities, how will the portfolio perform? Rather than trying to predict any one outcome. So for us, the first port of call is diversification. The second is to say, you know what, inflation-linked bonds are offering you inflation +5, and in that type of environment are actually quite well insulated from the risks of a destabilization in the government of national unity, because in that environment, one would expect the rand to depreciate and inflation in South Africa to tick up and be quite large. I mean, you saw a similar type environment in Turkey over the last 2-3 years, where inflation was running kind of in the region of about 40 or 50%. Inflation-linked bonds delivered 55%, nominal bonds delivered 0 returns. So definitely not only in terms of globally diversifying the portfolio, we have about 36% of the portfolio invested offshore, but we've also kind of built in a lot of protection through inflation-linked bonds. And again, it's about getting the balance right in when building portfolios so that the return can be robust across multiple different scenarios. Another question, given the historical divergence in performance between South African equities and developed market equities over 2 decades, what is your perspective on the potential of cryptocurrencies as an alternative or complementary asset class? Yeah, I mean, no comment on specifically cryptos. I mean, I will say that Bitcoin looks to trade very much like a growth asset, very highly correlated to things like the NASDAQ. And when there is a risk-off environment, it seems to sell off a lot more. So diversification benefits in that case don't necessarily are necessarily that significant. I mean, just as a tangent, what's going on out in the sort of the broader crypto environment does talk to speculative excess and leverage. If you think about Trump coin was launched 2 weekends ago, and out of thin air generated 12 billion. There's something else called, excuse my language, fart coin, which again is worth about, at its highs was worth about 2.5 billion. That's larger than listed companies like Old Mutual or Momentum in South Africa. So there really is certainly signs of excess and speculation, which is the third sort of behavioral aspect that needs to go alongside overvaluation and the new best thing in creating bubble-like narratives. Unfortunately here, there are lots of questions here. We're running out of time. We've hit close to the hour. We will get to all the questions that have been posed. We'll respond to you. We have noted them all down. So we will get responses either by myself or the broader investment consultant team will reach out to you. I'm just going to take this opportunity before we wrap up to first say thank you very much for supporting us over 2025 and over 2024 and supporting us into 2025. For being clients of us, we really think of that as the ultimate privilege to manage your money in terms of delivering better retirement outcomes for you. You can be sure that we've got a very singular focus in terms of ensuring better retirement outcomes in terms of building the portfolios, and wish you all the best for the year ahead. It's no doubt going to be one that is set with lots of volatility, lots of headlines as we work through what a Trump presidency means. I mean, even over the weekend, there were a lot of comments around sort of Chinese AI, large language models, potentially creating concern for a lot of money that's been spent in the US. But despite that, remember, understand how you're invested and manage your expectations accordingly to ensure that you can generate your returns well above inflation. if we do go into periods of market volatility, stick to the long-term plan, because panicking at periods of sort of large sell-offs or peak pain is a surefire way to destroy wealth, and certainly keep an eye out as we continue to communicate with our clients over the coming year. So again, thank you very much for joining us. I'm going to sign off now as we've hit our limit, and we'll certainly get to answering the questions for you going forward. So thank you very much for joining today. Cheers.